The Bulls versus the Bears. Get in the game. www.tackletrading.com.
Hello everybody, this is Coach D with tackletrading.com. I wanted to walk you through a trade repair and a trading adjustment that I've got that I'm mimicking here in the virtual account. I've got a position on GMCR, long stock position, 300 shares. This is one I did a video on earlier showing you how to cost average the trade and to sell a few more calls. Now overall I'm still actually quite profitable on this trade. But the stock position, you can see the 300 shares are down about $2,500. Now there's a $33,000 some odd dollar profit out there, and the short calls minus 3 calls, they're up about $1,000. So it's really mitigating those damages that we have there. And the issue we have that we really need to watch out for is the stock price, where it's actually sitting right now, is perfectly hedged to the break-even point, assuming the stock stays above the current price. The issue we have is the earnings is coming out after the market closed today, and the position's at risk. So I'm going to kind of have you look at the overall position. So you can see where this red line on the expiration, so this is the covered call, and the stock price is currently trading right here at 124 and change. Not the break-even point on the position, it's just right below it at 123.24. So there's really no margin for error to the downside in the case that it gaps down. If it runs back to the upside, the trade will actually come out profitable. So you can kind of see at expiration, if you look down in the left corner there, you can see that red number. You'll see that it'll actually come out $500 positive. And this is where the time decay, and then without an earnings announcement, you'd sit and rely on the time decay to repair the trade and the direction of the price chart. So when you look at the chart, it's down, it's been getting beat up. I'd call it a bearish retracement. And you got that earnings announcement, which is going to make it go whichever way. And this has been a stock position that I was willing to defend, that started out, back here at a breakout, nice profit, hedged into that, walked away with the profit, re-hedged. So this has been going on for a little bit of time now. And now with that earnings announcement and on the risk graph here with just the lack of downside protection, what has to happen to this is I need to take an adjustment. So I'm going to walk you through what needs to happen. The first thing I need to do is roll down, and I need to lock in that $1,000 gain right there. So that's the first thing I'm going to do, is go ahead and close out the short calls, and we're going to buy those back. And that will unhedge the position. Need to pick those up for the mid price, and we'll go ahead and get that in, see if we can get that filled. Now, in the meantime, while we're looking at that, what we'll try and do here is show you the adjustment. So that's coming out of the equation here. Let's go analyze closing trade on that. So it'll show us the 6. We're putting in the ask for the 650 on that. And what that does is it moves the stock break-even point down to about 130 compared to the purchase price of 133. Now I'm going to add a caller to the trade, and the position has been here in February, and I would still want to roll down and out, and I can use the weeklies here. I can go use these weeklies here, and I need to re-collar the position. Now I can use any strike price really at this point if I wanted to. What I'm really ultimately after is to have some good extrinsic value, and what I want is the extrinsic value to be strong enough, high enough to pay for the ask price. So extrinsic value on the call enough to pay for the asking price on the puts. And so we're pretty darn close here with those. If I go out to the next expiration, and I could, it's trading at near 125, I could just use the current ballpark price. And here I can actually cover that position right here. So we can go, what we want to now do is we can create, analyze, sell trade. I think we can do what's called a synthetic collar. So collar synthetic combo. And that is going to be selling the call and buying the put for a 65-cent credit. We need to do 3 of those. All right, so we are going to create that duplicate order. Okay, so we can get that filled for the 65-cent credits, the hope, and that's going to sell the 124 call, take the money and turn around and buy the 124 put. And that is going to be a perfectly hedged out position. Well, now we got to probably bring it down to the 55-cent mid price here. We'll see if we can get that filled. Frustrating when your bid-ask spreads change, but that's going to basically create a hedged out position. If you kind of look here at the net delta of that position, so we have the negative 299 and the positive 300. That's 299 and change. And if you look at that whole number, I mean, that's about as close to neutral as you'll get. So we completely lock down the position as is, and it will show that when the position gets filled, the delta will be neutralized. It'll lock down your delta and give you a nice little neutralized position on that. So as we pull those out here, boom. There's your stock position. The goal would be to get your delta neutralized. So it gives you a funny looking little graph here, and the profit and losses here don't really account for any of the other trades as they've been booked, but it would keep any gains or losses from getting bigger. That doesn't account for the $1,000 profit we just locked in from the other calls. Doesn't account for any of the other trades, but it takes the trade and neutralizes it flat, and this kind of looks funny. But if you kind of look up and down this little scale here, it's pretty much neutralized. So if the stock goes up, you'll win on the stock, you'll lose on the options. If the stock gaps down on earnings, you'll lose on the stock, but you'll win on the options. And the synthetic short, just to make sure you understand that part, let me come back here and show you that. The synthetic short literally creates, it looks just like a short stock position. So if you look at what the position is comprised of, you have the 300 shares of long stock, which gives you the risk graph, that nice 45-degree angle. If we look at the short position, it's the exact opposite. It looks just exactly like a short sell, and it's that sold call and bought put at the same strike price creates what we would refer to as a synthetic short. This is Coach D with TackleTrading.com. Hope you enjoyed this trade repair. Again, just to recap, we went from a covered call position, which we bought to close the call, and rolled down and out, down a little bit in strike price, one strike, down, out a couple 30 days, and collared the trade so that we would be able to ride through earnings without being worried about whether it's going to gap up or down. But essentially, we batten down the hatches for whatever storm that earnings brings, and it allows us to sleep at night without worrying which way the stock is going. Coach D, TackleTrading.com.
Get off the sidelines and take control of your financial future at www.tackletrading.com. Get in the game.